Most Americans think they need $1 million to retire comfortably, but the shocking truth about actual retiree income will completely change how you view your retirement planning. If you're over 50 and wondering whether you're on track, this video breaks down exactly where you stand compared to the average retiree and gives you actionable steps to maximize your retirement income. We're diving deep into real retirement numbers, 3 different scenarios that show how retirement looks across income levels, and the specific steps you can take right now to improve your financial position. Plus, I'll share the tax strategies most people miss that could save you thousands. Stay until the end, because I'm revealing the biggest retirement planning mistake that could cost you your financial security. Before we jump in, hit that like button if you're serious about taking control of your retirement, and subscribe for more straight talk about money after 50. Your future self will thank you. Let's start with the reality check most financial advisors won't give you. According to the Social Security Administration's 2024 data, the median retirement income for Americans age 65 and older is approximately $47,000 per year. That breaks down to about $3,900 per month. But here's where it gets interesting. The average is actually higher at around $65,000 annually, which means some retirees are pulling the numbers up significantly, while many others fall below that median line. The Census Bureau's most recent American Community Survey shows that 25% of retirees live on less than $25,000 yearly. Meanwhile, the top 25% enjoy incomes above $80,000. This massive spread tells us that retirement isn't one size fits all, and your planning strategy needs to reflect your specific situation. Now let's talk about where this money actually comes from, because understanding income sources is crucial for your planning. Social Security remains the foundation for most retirees, providing about 40% of retirement income on average, according to the Social Security Administration. The maximum Social Security benefit for someone retiring at full retirement age in 2024 is $3,700 monthly, but the average benefit is actually closer to $1,800. Here's something most people don't realize about Social Security. Your benefit calculation uses your highest 35 years of earnings, adjusted for inflation. If you worked fewer than 35 years, zeros get averaged in, which dramatically reduces your benefit. This is why working longer can significantly boost your Social Security income, especially if your recent earnings exceed your earlier career years. The second major income source is employer-sponsored retirement plans. Traditional pensions are becoming extinct, with only about 15% of private sector workers having access to them, according to the Bureau of Labor Statistics. Instead, most people rely on 401k plans, where the median balance for Americans aged 60 to 69 is around $65,000, according to Vanguard's 2024 participant data. That's far below what most experts recommend. Personal savings and investments make up the third pillar, but this is where we see the biggest disparities. The Federal Reserve's Survey of Consumer Finances shows that the median retirement account balance for families aged 65 to 74 is about $66,000, while the mean is over $200,000. This huge difference highlights how some Americans have substantial retirement wealth, while others have very little. Let me introduce you to 3 real people whose stories illustrate how different retirement can look depending on your planning and circumstances. Meet Sarah, a former teacher from Ohio. She taught for 30 years, contributing to both the state pension system and a supplemental 403b plan. At 67, Sarah receives $2,800 monthly from her pension, $1,600 from Social Security, and draws about $800 monthly from her retirement accounts. Her total monthly income is $5,200, putting her above the national average. Sarah's story shows how public sector benefits can provide retirement security, but she still feels the pinch of inflation on her fixed income. Then there's Marcus, who spent 25 years as a factory supervisor before his plant closed when he was 58. Unable to find comparable work, he took early Social Security at 62, reducing his benefit permanently. Marcus receives $1,300 monthly from Social Security and draws from a small 401k that he's trying to stretch. His total monthly income is about $2,200, well below the median. Marcus represents millions of Americans whose retirement plans were derailed by economic circumstances beyond their control. Finally, consider Linda, a successful small business owner who sold her marketing firm at 62. She delayed Social Security until age 70, maximizing her benefit to $2,700 monthly. Combined with income from her investment portfolio and the proceeds from her business sale, Linda enjoys a comfortable retirement income of about $8,000 monthly. Her story demonstrates how business ownership and delayed Social Security can create substantial retirement wealth. These three scenarios highlight a crucial concept called tax diversification. This means having retirement income from different sources that are taxed differently. Social Security might be partially taxable. Traditional 401k withdrawals are fully taxable, but Roth IRA withdrawals are tax-free. Understanding this helps you control your tax burden in retirement. The tax implications of retirement income are more complex than most people realize. Social Security benefits become taxable when your combined income exceeds certain thresholds. For single filers, if your combined income is between $25,000 and $34,000, up to 50% of your benefits may be taxable. Above $34,000, up to 85% becomes taxable. Traditional retirement account withdrawals are taxed as ordinary income, potentially pushing you into higher tax brackets. This is why many financial experts recommend Roth conversions during lower income years, allowing tax-free growth and withdrawals later. However, the Tax Cuts and Jobs Act provisions expire after 2025, potentially changing tax brackets and making current planning strategies less effective. Required minimum distributions present another tax challenge. Starting at age 73, you must withdraw specified amounts from traditional retirement accounts annually. These forced withdrawals can push retirees into higher tax brackets and make more of their Social Security taxable. Recent legislation raised the RMD age from 70.5 to 73, providing some additional tax-deferred growth time. Medicare adds another layer of complexity. Medicare Part B premiums are income adjusted, meaning higher income retirees pay significantly more. The income-related monthly adjustment amounts can add hundreds of dollars to your Medicare costs if your income exceeds certain thresholds. This creates a cliff effect where small increases in income can trigger large premium increases. Recent policy changes have created both opportunities and challenges for retirement planning. The Secure Act 2.0, passed in 2022, includes several provisions affecting retirement income. It increases catch-up contribution limits for those over 60, allows penalty-free withdrawals for certain emergencies, and provides tax credits for retirement plan contributions by lower-income earners. However, the Act also changed rules for inherited retirement accounts, requiring most non-spouse beneficiaries to withdraw inherited account balances within 10 years. This could significantly impact estate planning strategies and create tax burdens for inheritors. Inflation has emerged as a major threat to retirement security. The Consumer Price Index showed inflation rates above 9% in 2022, eroding the purchasing power of fixed retirement incomes. While Social Security includes annual cost of living adjustments, many pension plans don't, leaving retirees vulnerable to rising costs. Healthcare costs represent perhaps the biggest wild card in retirement planning. Fidelity estimates that a 65-year-old couple retiring in 2023 will need approximately $315,000 to cover healthcare costs throughout retirement. Medicare doesn't cover everything, and long-term care costs can quickly devastate retirement savings. Geographic location dramatically affects retirement income adequacy. $47,000 goes much further in rural Mississippi than in San Francisco or New York City. Many retirees are discovering the benefits of relocating to lower-cost areas, effectively increasing their purchasing power without increasing their income. Now, let's break down your retirement income planning into 5 actionable steps using everyday language. Step 1 is calculating your retirement expenses, not just your current expenses. Retirement spending patterns typically change, with some costs decreasing like commuting and work clothes, while others increase like healthcare and leisure activities. Create a realistic budget that accounts for inflation over your retirement years. Step 2 involves maximizing your Social Security benefits. Every year, you delay claiming Social Security past full retirement age until 70 increases your benefit by 8% annually. This is guaranteed return that's hard to beat in today's investment environment. Also, ensure your earnings record is accurate by checking your Social Security statement annually. Step 3 focuses on optimizing your retirement account strategy. If your employer offers matching contributions to your 401k, contribute enough to get the full match. This is free money. Consider Roth contributions if you're in a lower tax bracket now than you expect to be in retirement. If you're over 50, take advantage of catch-up contributions that allow you to save additional amounts beyond standard limits. Step 4 is addressing the healthcare cost challenge. Consider a health savings account if you have access to one. HSA contributions are tax-deductible, grow tax-free, and withdrawals for qualified medical expenses are tax-free at any age. After 65, you can withdraw funds for any purpose without penalty, though non-medical withdrawals are taxed as ordinary income. Step 5 involves creating multiple income streams for retirement. This might include part-time work, rental income, dividend-paying investments, or starting a small business. Multiple income streams provide flexibility and reduce dependence on any single source. The biggest mistake I see people make is assuming they'll automatically spend less in retirement. While some expenses decrease, others often increase, and inflation affects everyone. Healthcare costs alone can overwhelm budgets, and many retirees underestimate how much they'll want to spend on travel, hobbies, and experiences they've been postponing. Another critical error is not considering the sequence of returns risk. If the stock market performs poorly early in your retirement when you're making withdrawals, it can permanently damage your portfolio's ability to recover. This is why many experts recommend a bond ladder or cash buffer to avoid selling stocks during market downturns. Tax planning in retirement requires a different approach than during your working years. It's not just about minimizing taxes in any single year, but managing your lifetime tax burden. This might mean paying taxes now through Roth conversions to avoid higher taxes later, or carefully timing withdrawals to stay within favorable tax brackets. The reality is that most Americans are not adequately prepared for retirement, but that doesn't mean you can't take action now to improve your situation. Whether you're 55 or 75, there are strategies to optimize your retirement income and make your money work harder for you. Remember that retirement planning isn't just about accumulating money. It's about creating a sustainable income stream that maintains your lifestyle and provides security throughout your retirement years. The earlier you start implementing these strategies, the more time compound growth has to work in your favor. Your retirement doesn't have to look like anyone else's. By understanding where you stand compared to average retiree income and taking specific action steps, you can create the retirement you actually want rather than settling for what happens by default. Now I want to hear from you. Drop a comment below and tell me what age you're planning to retire and what retirement planning challenge you're facing right now. Are you worried about having enough money, dealing with healthcare costs, or figuring out the best withdrawal strategy? Share your specific situation, because your question might help other viewers who are dealing with the same issues. If this video helped you understand where you stand with retirement income, smash that like button and subscribe for more practical money advice for people over 50. And remember, taking control of your retirement planning today is the best investment you can make in your future security and peace of mind.